we're going to get started. We'll just bring up our first our slide here. I want to thank everybody for joining us today. My name is Rob Belvedere. I am Executive Vice President of IBA. For those of you that are not familiar with us, IBA is a third-party administrator that specializes in self-funded medical and dental plans. We are located in Garden City, New York, out on Long Island. We work in the employer marketplace and specialize in working with employer groups from anywhere from 50 to about 2,000 lives. Today I'm going to talk a little bit about stop loss and how that ties into a self-funded health plan. I'm going to start by talking a little bit about what attracts first-time utilizers of the self-funded health plans as well as current utilizers in terms of the value that a self-funded health plan delivers. And I'll do so over the next few slides to just break that down to everybody. All right. So if you were to look or wake me up at 4 o'clock in the morning and ask me, period, point blank, what are the advantages of a self-funded program over a fully insured program, they would be broken out on the following chart. What I like about this chart is it really dictates to the end buyer or utilizer of the plan of the expenses that they're currently paying for in a fully insured environment. So, the first four on the chart are relatively routine and are going to exist in any plan, whether fully insured or self-funded. However, I will admit, point out administrative cost in a self-funded plan is often a fixed monthly number tied to a per employee per month cost, where in a fully insured environment, the administrative cost is also some type of retention fee, which is a percentage of claims. So there is some differences there while they do both exist in both worlds. Going on to some of the differences, one of the things that, a self-funded plan does not need to accrue for are reserves. And reserves are dollars that you need to set aside for future claims. Obviously, in a fully insured environment, that is 100% something you need to accrue for, and that's done outside the plan. The other big aspect are pooling charges. Pooling charges are the internal stop-loss fees that exist inside a fully insured contract. With self-insurance, that there is a pooling charge. However, it is a movable piece that we're going to speak about today. So stop-loss insurance really replaces a pooling charge for a self-funded plan, all right? One of the nice things about a self-funded plan is that pooling level is movable, all right? And we can dictate what that level is going to be, through specific stop loss, and dictate it and tailor it to a client's needs. All right. So if you were to look here at our book of clients at IBA, anywhere between, let's just say 50 and 1,000 lives, some of them might have similar demographics and stop loss deductibles, while others might not. And that's simply based on the client's risk tolerance. And one of the things that self-funding is able to do is truly identify a client's risk tolerance and get them to recognize how it works in tandem with their health plan. Okay. Another big avenue are premium taxes. In a fully insured environment, a employer is subject to pay premium tax on the entire premium that they pay to the carrier. So if they're fully insured with United Healthcare and they're paying $2 million, they are thus paying premium tax on the entire $2 million of premium they are paying to the carrier. In a self-funded environment, the only component that employer is responsible to pay premium tax on is the actual true insurance component, which is their stop-loss premium. So much different scenario. You'd look at a client that was paying $2 million of fully insured premium, and now they're looking at paying a premium on only maybe $300,000 for a stop-loss. All right, so there's a big difference in the premium taxes. The other big one that sticks out to everybody is insurance company overhead and profit, right? So that does not exist in a self-funded environment. You pay the true cost of claims. You pay what it is to run the plan on a monthly basis. there is no need to build in for overhead and profit, because thus you're eliminating the insurance company aspect of the plan when you go self-funded. All right. And then obviously the last one we're going to talk about today are stop loss premiums. Generally, a client that moves to a self-funded arrangement is saving about 10 to 15%, and then granted even further than that. We track every group that we write. The majority of the groups that we write, I'd say 80% of them are or were fully insured prior to becoming self-funded. And we find that the savings is somewhere around 18% on average the first year. And then going forward, the increase obviously less than a single double digits. So when we stack it up against fully insured, which we'll show you at the end of this presentation, you can see the savings are quite substantial. Just a little quick overview of how self-funding works. In a self-funded plan, the employer assumes some of the responsibility or all of the responsibility, right, for the claims. Depending on how much of that responsibility they assume is indicated by the stop loss levels that they purchase. A third-party administrator like IBA, we provide all of the customer service for the plan, the payments of claims to providers, the member customer service, day-to-day plan eligibility, and account management. It's our job to run the plan day-to-day, to pay providers, to handle member customer service, and then often behind the scenes, take care of stop loss and the other financial aspects of the plan. Stop loss coverage is often purchased, okay? So the majority of self-funded plans do purchase some type of stop loss protection. The really, really large plans technically usually only have specific stop loss protection, where smaller plans generally under 2,000 lives will have specific and aggregate protection. All right. Stop loss is important in that it covers or reimburses the employer for individual claims that are in excess of a specific deductible or on an aggregate basis. All right. So there's two types of protection an employer can purchase. We recommend both to the employers generally we work with here at IBA, both specific and aggregate coverage. They work in concert with each other to protect the client on both bases. So to just get into a little bit about the different types of coverage, you'll hear the term spec or specific stop loss, and that's just what exactly it is. It's specific to each individual member enrolled in the plan, and it's going to protect the employer up to a specific dollar limit or above that dollar limit with coverage. All right. So let's say, for example, a client has a $50,000 specific deductible. That deductible covers both medical and RX claims. The employer is thus responsible for the first $50,000 of claims on any individual member during that contract period. Once a member breaches the $50,000 limit, the stop loss carrier then steps in and begins to make claim payments on behalf of that member and the plan. All right. Our function as a TPA is to obviously file those stop loss claims, work with the stop loss carrier to have them paid appropriately. When we get a few more slides in, we'll talk about some of the advantages of having stop loss contracts set up correctly and what that means for a client in terms of protection. All right. The second type of coverage is aggregate stop loss protection, and this is paid against the total paid claims exceeding a predetermined combined dollar limit. So when an underwriter looks at a group's demographics and their claim exposure, they come to a determination of what they expect the claims experience are going to be for that group. All right. If an underwriter looks at all stop loss and underwrites all of his book of business the same, he knows that if he puts a 25% risk corridor on top of that expected number, that is the aggregate stop loss limit that if a client purchases, they are less than 1% to go over. All right. Aggregate insurance is thus a backstop for a client, right? So when we sit down with clients, we talk about two different limits specific to the individual, now aggregate to the whole entire company. All right. So that allows us to give a plan a max cost. All right. We can say to a client, your fixed costs to run a plan are going to be comprised of your stop loss costs and then your max in claims underwritten by the stop loss carrier during this contract period is $1 million, let's say. All right, so we have a hard stop for the client on both a specific basis and an accurate basis. All right. Any monies that are paid over the stop loss deductible on an aggregate basis are thus refunded to the client as well in the form of a claim. Little pop quiz here. I don't know if we're going to open this up to people or.
Yes, they see this right now.
All right. So the first one, self-funded health plans are almost always governed by. Hopefully folks know this. Obviously, ERISA. Okay, you know that self-funded health plans are not governed by state insurance commissions or obviously the IRS. All right. All self-funded health plans fall under ERISA guidelines, thus making them a little potentially more liberal in some areas of benefits. Healthcare reform has narrowed that gap somewhat, but there are obviously still some advantages to the plan design you can have in an ERISA-based plan versus a state-based plan. All right. Question number 2, using disease management or wellness programs to help control claims exposure are commonly referred to as loss containment strategies. So this is one of the things that we speak about here at the TPA, in addition to ways to control costs through network discount, claim negotiation. Wellness programs and disease management are excellent add-ons to any client's portfolio that do have a return on investment and can potentially lower claim costs over time. All right. Stop loss contracts. So this is where people often get somewhat thrown amok with stop loss. Stop loss is pretty easy to understand on both a specific and aggregate basis, and that's in terms of what type of coverage you're going to buy. But then now we come into stop loss contracts and what those mean for a client, especially a first-time client, when purchasing stop loss. And we often get asked, well, what do you recommend, first year to a client coming fully insured, going to a self-funded plan? What's your recommendation to a client? And my answer to that is generally I don't make any specific recommendation. I believe that our job as a TPA and everyone's job as a broker is to thoroughly be able to convey the product that they are selling to the end user, that is the client. And then based on their risk tolerance, if you have, given the information out correctly and in a way that's logical, the client can then decide what it is that they're liking to do in that first year. All right. Some clients gravitate to the 12-12 contract. Some gravitate to the 12-15 contract. So when we talk about stop loss contracts, the first number always relates back to the claim period that the claims were incurred in. So on a 12-12 contract, the stop loss contract is covering in claims that are incurred in 12 months. And then the second number is the paid number, all right, and are paid in 12 months, all right. So for those of you that are familiar with stop loss, as you know, a 12-12 contract is an immature contract, and that is due to something called lag. Meaning that if you incur a claim today, by the time the TPA gets that claim, adjudicates it, and pays the provider, it might be 45 to 60 days from the date that the claim actually incurred on. All right. So a 12-12 stop loss contract is an immature contract in that it will not capture all of the claims that were thus incurred in those 12 months. All right. So the other option first year for a client, because we're going to talk first year client right now, is to purchase a 12-15 contract or a 12-18 contract. That stop loss contract will cover claims incurred in the same 12 months. However, those claims in a 12-15 contract need to be paid in 15 months, and in a 12-18 contract need to be paid in 18 months. All right, so it thus gives the client run-out protection from their first year of claims. All right, and that client would then continue to purchase in the years after 12-15 or 12-18 contracts or 12-24 contracts year in, year out. So they would basically have a contract that would always have run-out protection. All right. A 12-12 contract, a little bit differently, like I had said before, we're looking at 12 months of incurred claims, 12 months of paid claims. So in year 2 all right, we're going to need to protect ourselves on the backside, meaning that we are going to need to then purchase a contract that is either a 1512, an 1812, or a 2412. And that will cover claims that go back either 3, 6, or 12 months prior to the contract being started, all right? And that would work well with any 1212 contract in the second and third and fourth years going on, all right? The attraction between the 1212 and the 1215 is that the client is looking at an immature number when they're looking at a 1212 contract year one. However, if you can explain that to the client and let them know that this is the first and only time that they're going to basically save in premium dollars, generally about 18% between that and a 1215 contract, then often sometimes they will choose the 1212 contract over the 1215 contract. Generally, I find clients that are more risk adverse go to the 1215 contract, where the riskier clients or clients that are less apt and understand this is a long-term purchase go to a 1212 contract. With stop loss, there are many optional riders that you can purchase that enhance the stop loss contract. I'm actually going to talk about these in reverse order. All right. The first is aggregate accommodation. So people often ask us, well, hey, can I build a level funded plan, with you as the TPA? The answer is yes. And the tool that we use is aggregate accommodation. Aggregate accommodation gives the client a monthly cap in claims that is cumulative throughout the contract, so they cannot exceed that dollar maximum ever throughout the claim year. All right, so if your client had a $1.2 million max in claims, they would have $100,000 basically aggregate every month. If they exceeded the $100,000 in any given month cumulative, then they would thus be reimbursed at that time by the stop loss carrier. It's good for smaller groups and groups that might have trouble with cash flow or budgeting purposes. All right. The next rider, which is sold on every piece of stop loss business that we write as a TPA, and I would imagine most others as well, is specific advance. And specific advance is pretty simple. When a member breaches their specific deductible, like I had said before, $50,000, at that point, the stop loss carrier steps in and the employer is not responsible for any claims above that deductible amount. And that is an important piece of any stop loss contract. The next two options are terminal liability options. All right. These are for contracts that don't have run out. So for 1212 contracts, 2412 contracts, the client can purchase a terminal liability option, which is less than buying run out protection, which simply states that if they at any time leave the self-funded plan and go back to a fully insured plan, they can have run out protection for 3 months. All right. It's commonly sold in the first year, and then after that, clients keep it on throughout the rest of the contract. All right. Okay. So, quiz number 2. All right. Stop loss protection for each individual covered under the health plan is currently referred to as, that one, specific stop loss. Self-funded health plans are not subject to the health insurance industry tax. True or false? True. They are not. The entire self-funded plan is not subject to tax, only the stop loss premium. Number 5, administrative costs associated with a self-funded plan are more costly than those within a fully insured arrangement. You know the answer to this? B, false. No, administrative costs tend to be about 35 to 40% less in a self-funded plan than in a fully insured environment. So we commonly see that. Even against another carrier self-funded plan, we are often, 20% less. Talk a little bit about some of the things IBA brings to a client when moving to a self-funded plan, right? So obviously, with greater plan flexibility, you're now no longer left with the cookie cutter approach of the big carriers out there, right? We're not left with a menu option of deductibles and copays to choose from. We dictate the terms of the plan, or the client dictates the terms of the plan through self-funding. Self-funding is a long-term strategy, so it is not for your client that is looking to do this for a year or two to save money on premium. It is a long-term strategy and solution to control cost and take control of your health plan. It has some significant tax savings over a fully insured plan. Talked a little bit about that earlier, and those can be significant over time alone. Cost savings. The cost savings that a client achieves through going self-funded, or like I said before, about 18%, and those stay through the interim of the plan, year through year, which is something that allows clients to get savings year over year, as well as dive into some things like pharmacy vendors where you might be entitled to some rebates and some other types of programs that you just simply can't tap into as fully insured. And the last, probably the biggest, is the employer and plan sponsor control, where we're able to, and with the employer, control some of the cost of the plan in terms of the types of ideas we offer to a client in terms of plan design, wellness initiatives, smoking cessation programs, and claim management. Big thing for us here at IBA in the last, I'd say, 12 months has been to introduce a steerage model to our clients to redirect clients to lower cost providers for commodity care, such as MRIs, lab tests, any type of testing or diagnostic imaging that's done outside a doctor's office. All right, page on. Working with the TPA obviously has advantages over working with a carrier direct. So a TPA does give employers greater control and a higher degree of accessibility to their plan. We do deliver a higher quality and lower cost health plan. We're able to offer multiple PPO networks, different UR vendors, and cost containment strategies that carriers will not. That seems to be one of the big differentiators between us and a carrier. We have a velvet glove approach when dealing with large or difficult claims in relation to stop loss. We know the carrier partners that we work with and the turnaround times associated with each. And we do have a much quicker turnaround time on claim payments and give employers the tools that can quickly modify their plan. So, for example, a client can make changes, 60, 30 days after the renewal if they see something cost-wise inside their plan that they want to address. All right. Also, quick turnaround time on claim payments. Just as a side note, we do an annual IBNR test here at IBA, and that tells us the time frame and how long it takes for us to pay a claim. And our lag frame is lag time frame this last year was about 9.8%. So the industry average is 19. So we're obviously well below that. We get claims in very quickly and they're out the door very quick as well. All right. So, this just shows the growth of self-funded health plans between now and through to 2016. So, if you were to look at percentage of workers covered in a partially or completely self-funded health plan, it has, grown dramatically. Do remember that the largest employers in the United States are self-funded, so that is one of the reasons you're seeing, rates as high as 82% in the penetration of all large firms. But generally, if you're over 200 lives and you are an employer group, there is a 82% chance that you are self-funded. So that is something that talks a little bit about the marketplace. Also, knowing, smaller firms under, between 3 and 200 lives, that has also grown in the last couple of years as well. It shrunk down in 2016, but that's, standing still at 13%. So obviously self-funding is popular for all the reasons we've talked about today, and employers are gravitating to it over time. The next two slides I'm just going to wrap up with. These are case studies that we have in our IBA materials here at IBA. This first slide talks about a client that was self-funded already with a carrier network and moved to IBA. And obviously you're looking at a client that we were able to save 14% on where they were with the carrier, all right, carrier ASO, moving to an IBA self-funded plan, all right. And the ways that we did it is we used a stronger stop-loss solution that was able to reduce the client's fixed cost. We were able to, perform billing audits and claim audits that found egregious provider charges and fraud. We introduced a stronger PBM, which is a pharmacy benefit manager, and we moved them to a stronger PPO network. So they were able to get some greater discounts than where they had been prior. Right? And you can see the savings over 3 years is net to the client about $1.3 million. Right? The next slide talks about clients that were fully insured prior to coming to IBA. And here, obviously, we're using the same type of methodology. However, the savings are a little bit greater in that the fully insured marketplace, we're showing an increase here of 10% on premiums year over year. IBA, we assumed a single-digit 9% increase, which actually we're less than that, but we went on the high side here. And you can see here for this client, this is an actual IBA client, one of my clients. Over a 3-year period, the savings has been over $1 million, $1.1 million, had they stayed fully insured and kept to swallow the increases that were being given to them by Oxford. They were an Oxford client at the time. So this is a good story. We're telling stories like this all the time to new prospective clients, and also, our clients are reiterating the stories to them in the form of references for IBA and self-funding as well. Self-funding is a tool that, if used properly, clients can save money and will save money on their health plan. It's a lot of times a matter of getting the client to listen and understand that the plan, when set up with proper stop-loss protection, is protected and just as safe as a fully insured plan that they're purchasing today. I'm going to open it up to some questions. Reed, if you want to pop that open. If anyone has any questions, wants to shoot me an email, my contact information is there. You can shoot me an email.